In today's video, we are going to look at the question of using qualified money I have in a 401k or IRA, for example, and using it to fund a cash value life insurance policy, a high cash value life insurance policy. So on this point, we often get the question, can I use money from my 401k to open a high cash value life insurance policy? And to take that a step further, we often hear, can I roll the money over from the 401k that I have not paid any tax on, and can I just roll it over or transfer it into a life insurance policy and not have to deal with any taxes? That would be wonderful if we could, but we cannot do that, unfortunately. A 401k is a qualified asset, and a cash value life insurance policy is classified as a non-qualified asset. So the only way we could get money from a 401k or IRA into a life insurance policy would be if we took a distribution. So if I take $100,000 out of a 401k, what's going to happen is I am taxed on the full $100,000 as ordinary income that's added to any other income I have, and I must pay taxes on that. Then whatever I have left over, I can use to fund a policy or a portion of it, depending on what I'm looking to do or how we're planning things out. Now, the next question is, does it make sense to move money from a 401k to a cash value life insurance policy? And does it make sense to do it while I am alive? Specifically, if I'm focused on the cash value, growing that, what does the cash value growth look like? I have access to it. The tax benefits, when I pull the money from the 401k, what am I potentially liable to pay taxes on? And I would always consult with a tax attorney or CPA there. And then what does it look like from a tax standpoint once it's in the life insurance policy? And then also from a legacy standpoint, what is the most efficient way to leave money to the next generation if that's something I'm concerned about? If I'm big on family wealth, constantly building, what's the pros and cons to just using a 401k to grow that at the fastest rate, leave the money to my heirs, versus potentially shifting all of it or a portion of it over to a cash value life insurance policy, not only to leverage the cash value while I'm alive, but also from a legacy planning standpoint and leveraging that death benefit, which on life insurance policies, that is paid 100% income tax free. So we're going to look at some numbers. I had a ton of fun putting this case study together because I enjoy this stuff. I nerd out with it. What we'll touch on first are several points of information that'll be valuable as we transition into the numbers here. So with a 401k or IRA, when we actually pay into it, we fund it with pre-tax dollars, meaning every dollar I have paid into a 401k, I have not paid any taxes on. I was able to deduct that from my income. It's grown tax deferred, and eventually when I access it, I must pay ordinary income tax on everything that I pull out. So I'm deferring taxes to a later date. Now, as it accumulates, it grows tax deferred. I'll say this about 401ks. The purpose is not to beat these up here. A lot of people have saved a lot of money for retirement, can do a lot of good with them. I've seen that they are a great way to accumulate wealth over time. It can just be challenging to distribute wealth. So that's where I want to look at strategies, how I can pull money personally from the 401k, and then also use it to leverage my own position as far as a legacy planning standpoint. And we'll get into that as well. Money is taxed when it is distributed. So if I take out $100,000 in a 401k distribution, let's assume I'm age 60, I will be taxed at ordinary income rates. I'm above age 59 and a half, so I don't have that 10% penalty anymore, but I'm going to be taxed as ordinary income. If I'm receiving income from any other sources, it's all added together. So if I have $100,000 of income from other sources, wherever it might be, maybe I'm still working or working a side job or have my own side business, and take $100,000 from my 401, if I have 100K each, that's $200,000 of taxable income. I've got to be aware of that, which most people are. Now, I've got the stock market risk and reward here. So what I mean when I say that is I can choose where the money's invested. I can go very aggressive in mutual funds, stocks, or I can go conservative if I go bonds, money markets. I've got a degree of control as far as where I want to put that money, how I want to grow, how I want to grow it, I should say. Maybe I have a manager that helps. There's also fees associated with it, but I do have the stock market, the risk and reward play, which I don't hate the market. A lot of good can be done with the market. Now, here's the number one drawback to a 401k is that beneficiaries, when they receive it, will pay income tax on the balance. And this is where some families have left wealth in a very inefficient manner. Granted, they still leave money to their beneficiaries, but if we've built up a large qualified nest egg, meaning IRAs, 401ks, everything tax deferred because I was afraid to pull money out because that inflicts financial pain on me. I've got to pay all this tax when I pull it out. So I just defer it thinking I'll do it eventually and it never happens. That's where eventually we kick the bucket. A large pile of money is left to the beneficiaries. Now they must pay income tax on the full amount. There are strategies to stretch it out or defer it, but eventually taxes will be paid. And that's where we hear stories where $5 million in qualified monies is passed, but $2.5 million is actually received by the beneficiaries after taxes and everything. So it can definitely eat into a legacy, but this is where we want to plan properly and look at different options. A cash value life insurance policy funded with after-tax dollars. So I cannot deduct the payments I make into a policy unless it's held within a qualified plan, but that's a different topic for another day. I can access my money, my actual cash value, completely tax-free, provided I have not triggered a MEC. If I don't cash it out, I've got to do it properly between withdrawals and loans, but I can access it tax-free if I do everything properly. Now, it is a safe area to position money. So we've got safe and fixed there. We're going to look at this case study for an age 60 male. So we can find projections that look good, but in reality, to set expectations properly, if I look at a whole life insurance policy with one of the major mutual companies that is properly designed, likely somewhere in the neighborhood of that 3 to 5%. That is a tax-free yield, so I don't have to deal with any taxes, but that's what I can expect the cash value to produce over time. And we're going to see that too. Now, I said if it's positioned with one of the major mutual companies and if it is properly designed. So we'll touch on that when we look at the numbers. Really what that means is a minimum premium 10/90 split, minimize the insurance expenses, which by the way will maximize the long-term death benefit as well, which works beautifully when I'm looking at the death benefit because that is paid 100% income tax-free and a great tool, one of the best in fact, for legacy planning. Now on the death benefit, I emphasize that word income tax-free. If I have a large taxable estate, death benefit proceeds are not exempt from estate taxes. That would be a position where I want to have my policy owned or held by a trust. Maybe I've got multiple policies for different purposes and different trusts. Like I want to plan properly if I've got a larger estate. Maybe I've got a family office, that concept as well, where everyone properly vets every decision and move that I make, which is kind of cool when you look at the concept of the family office. But let's look at some numbers here. So what we're going to look at is we've got a 401k here, age 60 male, balance $1.5 million. He has other sources of income. We're just going to solely focus on how he can use the 401k money to fund a life insurance policy to enhance his present position and also his long-term position in terms of passing money. He's got other assets and such. We're not going to go into detail in that on this video. All right, so first thing is first. What we're looking at is just the 401k here, a growth assumption. Pretty simple. Simple, straightforward, 5% earnings rate. So right now, he's got $1.5 million, no longer contributing anything. Pretty straightforward here at 5% per year. Here'd be the balance accumulation over time. Now we did not assume any RMDs here, which we would need to, but in this model, for the sake of simplicity, just growth, what's it look like over time? So what we're going to look at is different distribution models here. So this will be fun, depending on one's definition of fun. So what we've got, two models. One, assuming the same 5% rate, 401k and IRA money. What we're going to do here, look at our balance first, 1.5. Interest rate assumption at the same 5%. The gross distribution we're going to pull out over 6 years, $300,000 per year. So that will result in a significant tax burden depending on any other sources of income we have as well. Assume he's living off of $200,000 per year, perhaps from a business he owns. We see this quite a bit. If he takes out $300,000 and he already has $200,000 of taxable income, what's that mean from a tax standpoint? Yeah, $500K of taxable income that we have to account for. Usually the people we work with have CPAs, accountants that they work with to make sure this planning is done properly, which I'd always recommend. So if you are working with us or considering it, we would work with your professional. If you don't have one, we have a phenomenal tax attorney, really estate planning, but her firm deals with taxes domestically and internationally. She's brilliant when it comes to taxes and cash value life insurance. So here we go. Here's the gross distribution. So where we came up with these numbers, especially year 6, that last distribution here, which drains the account to zero of about that 270, is what we're doing is assuming the 5% earnings rate all the way through. So it's still earning 5% while we're taking those distributions out. Now, we assumed a 30% tax rate on the $300,000. So that's going to take $90K off the top, whether we have it withheld or not. $90,000 at 30%, it's got to be paid in taxes. So we're going to pay that, and then the last year is about $81,000. We could tally that up, but I mean, that's a lot going out the door in taxes, but that's what happens with qualified money. Now, for comfort's sake, what some people do is say, hey, that's too much, that's too big of a pill for me to swallow right now. Let's spread this out over 10 years, and that way I can lessen the tax bill over time. The thing I want to mention here, however, and this is not a scare tactic to say, get all your money out now, it's going to blow, as I say this, has to do with taxes, because this has been on everyone's mind lately, and I think everyone knows what's happening here. Over the next 5 years, especially 10 years, what do we expect to happen with taxes as far as brackets and rates? Likely go up. Regardless of what happens when it comes to taxes with qualified funds, this is a component we, as an individual, do not have control of. When we take that distribution, whatever the tax rate is, we're taxed on it. Maybe we have deductions, things we can offset some income tax with, but we're taxed on it. So with that out of our control, a lot of people we work with like getting money out of the qualified accounts first, whether it's an aggressive strategy like this, or if you've looked at any of our other planning videos, how we will incorporate qualified funds with everyone, with all the other assets, I should say. So here we go, at 5%, pulling out $300 per year. Here's the net distribution we take out each year, $210 for 5 years, and then $188 and change in year 6. We also ran it at 0%, not really realistic, but this is for individuals that go very conservative. A lot of cash cows lately. What I mean when I say that is people, just with all the uncertainty right now, are not comfortable with their money in the market. They've put it into bank accounts, money markets, safe areas. This assumes qualified funds, but still, if we're not comfortable with anything, with any risk, that's where cash value life insurance can do a lot of good. We see a lot of banks just pumping money into products right now for that same reason. So same thing here. This just assumes at 0%, we'd only be able to get $210,000 out for 5 years, and year 6, on this example, we got another $270, based on the 5%. So that shows the power of compounding. If we're able to earn interest, obviously that lets us pull a lot more money out. So next model, what we're going to look at here. This just displayed again the IRA based on growth only, and then what it looks like if we distribute it. So there's our net distributions. We're going to run with the 5% model. IRA transfer. What we're going to look at here now is taking that 5% model we just looked at and what it looks like actually going into the cash value life insurance policy. So age 60 male, ran them at preferred. This will look identical. There's the 401 and IRA balance, spending it down over 6 years at that 5% interest rate assumption. And by the way, we built it out. It's a pretty simple Excel formula. We can change that interest rate to whatever we want. We can adjust it each year. Very simple. So if you'd like to work with us and kind of play around with different figures, we can do that kind of stuff. And if it's not qualified money, the tax situation would be different depending on where the money is actually. I don't want to just completely exit out. So distributions, taxes, net distribution, and here's exactly what we're going to do. Move the money over here. So one thing I like to mention here is we are repositioning, moving the assets to a high cash value life insurance policy. I do not like the word purchasing a life insurance policy because that would just be a pure premium policy. So we talked about policy design earlier. We've got $210,000 going toward this policy. What I'll note here is the minimum premium is a little over $19,000. We've got a term rider attached as well, but we are flowing money into the PUA component, which builds the cash value. So this individual is looking at the legacy plan, which we're going to look at long term, but he wants his cash there. He said, okay, I like the idea of this life insurance. Show me how it works, Steve, but I've got to see the cash value there so I can continue to use it. Maybe I want to pull income from it for retirement, but I want to see it there. I don't want it to take 10 or 15 years to break even and get my money back. Like that, don't even show me that. So that'd be a traditional policy. So here, funding for 6 years. Again, we just moved the net distribution. Total outlay. This is great because we can track his break-even point. So the drawback to this really is in the first year where I pay in $210,000 and I've got $186. Drawback in respect to the cash value because of that minimum premium. Even though we minimize the hit as much as we possibly can within the boundaries of the IRS limits, the insurance company limits, we still have that here. Now granted, we've got a death benefit immediately of $3 million. So if something did happen to him in the first year, what we did was begin to transfer funds from a qualified asset, and now we've got this death benefit that is paid out how? 100% income tax free. And you've still got this balance in the IRA. Now, as time passes, year 2, he pays in $210,000. How much does it grow by? He gets the $210 back, plus about another $1,000, a little bit less. On the right, you've got the annual internal rate of return. This isolates what the cash value is growing by year over year. This is a whole life policy, not an indexed universal life. Year 1, negative 11%. Again, that's the hit. Year 2, he pays in $210,000. Doesn't really get much, 0.017%, but in a bank account, you get the tax benefit too, but like, all right, tax benefits off of 0.17%. But again, the annual internal rate of return, and we see it get stronger and stronger each year. And really the reason why is that the insurance company is going to overcharge me for the minimum premium piece, which is about $19K. It's about $22K really, because I've got a term rider on there as well for full transparency. But that's the hit. Beginning year 2, that minimum premium comes back to cash value. This is why I see the internal rate of return accelerating. And this is an effective tax-free yield. So we've got the question, if I'm in a 30% bracket, what would I need to earn in order to net out 4.5%, 4.7% tax-free, because I have to pay taxes on any of the gains if I have my funds elsewhere where taxes are due. But again, why he's doing this, he likes the guarantees, no market exposure, not tied to the market, invested in there at all. So he likes the guarantees / safety, the liquidity, and then really, let's put this here, the tax benefits. So we've got an individual that is concerned about what's going on with taxes and wants his money somewhere where he is sheltered in that respect. This is why he wants to stuff the policy further. So moving money from the IRA over to the life insurance policy. Here we're just hitting on the cash value to help with one's understanding there. Average internal rate of return shows the overall IRR, factoring in the early years, which pull down my average. Tops out a little over 4%. If I look at it by age 75, for example, 4.01%. There we go. So this is what it looks like over time. Okay, so I've effectively transferred money from my qualified account over to the life insurance policy, and here's what it looks like as time passes. If I look at when I may pass, could be age 90 or 95, what do I have? Cash value about 4 million, death benefit 4.5, 95, about 4.75 in cash value, almost 5.2 in life insurance. Okay, that's all well and good, but what does it look like compared to the IRA if I would have just let that continue to accrue at 5%? Where's the difference with a side-by-side comparison? That's the kind of stuff I want to see up front. Let's make this a bit bigger. Sweet. So what do we have here? On the left, we've got the life insurance policy we just looked at. Took out the IRRs in this example because we have them on the last slide. But here's the policy. Identical funding, everything's the same. Year 7, by the way. There we go. Year 7, you will see that death benefit drop. We deliberately reduced it here in order to improve the performance. That is optional. We can design it where it does not drop. But here's what I want to look at. As time passes, the death benefit proceed is paid out how? Income tax free. The IRA proceeds or 401k proceeds are paid out how? Not income tax free. So we've got two scenarios over here. When I die, so if I died immediately, I have 1.5 million in my 401k. My beneficiaries, not my spouse, there's no taxes there, it's when it goes to the next generation, my kids, for instance, when they receive that, what's going to happen here? Well, if 40% comes off the top, they'd receive a net of $900,000. If it's 50%, they'd receive a net of $750,000. Depending on your situation, we can easily change the numbers. It's very simple to do as we compare this chart looking over time. So as we scroll down here, a couple things that are good to look at. If I'm focused on the cash value, let's look at, you know what, let's do this actually. Beautiful. If I look at age 80, focused on cash value, what happens? We're transitioning to the legacy play now. I've got 2.6 million in cash value. The IRA balance, almost 4.2. Big difference there. IRA balance, though, is what? Taxable. I'd also be forced to take RMDs out, but I could have also done better than 5%. But 4.2 versus 2.6. That's where an argument can come up, hey, look at the difference. However, taxes, no taxes. Okay, that's great. But legacy play. So if I die at age 80, death benefit here, 3.5 million. If I die with the $4.2 million IRA balance, if 40% is taken off the top. What is left in terms of a legacy? $2.5 million difference. If 50% is taken off, and this really depends from a legacy standpoint, really how your kids are doing, how much money they receive. If the kids are well-to-do, if they're earning a healthy income, that's where a big chunk could come out, or if you leave a large balance. So what am I better off with here? From a pure legacy standpoint, that's where the death benefit starts to come in and we can leverage it. And typically with this is not all of a client's money. We never propose put everything into life insurance. But what individuals do in these situations is look to transfer funds into a policy, whether it's all of it or a portion of it, but they do have other assets as well. It's a big picture, big play going on. This video is focusing on the qualified accounts here. Just to give it an example. Now, if we die at age 90, $4.5 million net death benefit, paid income tax-free. 6.8. If 40% comes off the top, $4 million left. That's the net amount. So 6.8 gross, $4 million net. If it's 50%, 3.4 net. At age 95, net death benefit, 5.1. If 40% comes off the top in the IRA, 5.2. Gross balance is almost 8.7 there, and just assuming the 5% all the way through. At 50%, 4.34. So this is the kind of stuff we like to look at, and you can kind of measure it out to say, okay, does it ever make sense to continue to grow money in tax-deferred funds? Usually I don't want to say usually it doesn't. Tax-deferred accounts do have their advantages, don't get me wrong. From a legacy standpoint, this is out of our control. The taxation particularly. The return, we put at 5%, somewhat conservative in my opinion, but we put it at 5%. You've got variables depending on where you allocate it. With the life insurance policy, you do have guarantees. Guaranteed to go nowhere but up. If we look at the guaranteed cash values, we've got that private contract, very simple, straightforward, peace of mind, gives us a permission slip to spend other assets. And we didn't touch on any of the cash value benefits, how we can pull our money out and it continues to stay at work for us the whole time. No lost opportunity cost. Very popular with real estate investors. So overall, the strategy can be very powerful. What it requires though is a bit of modeling, planning, and it's pretty easy. I mean, we've built this stuff out this way. You can just plug it in. If you've got a situation, can adjust the numbers, the returns very easily. But if you'd like to see it, feel free to reach out anytime. We'd love to connect with you and help you out in any way possible. I do hope that this helped. I'll talk to you soon. Have a great day. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.